4,000 years ago, in a city between two rivers, someone had a problem. They needed money but didn't have it. Someone else had money but needed more. A third person saw an opportunity, put the two together, take a cut. Banking was born not in Renaissance Italy, not in medieval Europe. In ancient Babylon, they invented credit, interest rates, loans, collateral, investment banking, insurance, even derivatives, every financial instrument we use today. Started in mud brick buildings along the Euphrates. This is how Babylon created the world's first banking system, and why it sounds exactly like 2008. Let's start with the basic problem. Farmers needed seed for planting season, but harvest was months away. They had no money now. Merchants needed to buy goods, ship them across trade routes, sell them in distant cities, but that takes time. Capital today, returns tomorrow. The timing never matched. Traditional solution: borrow from family, beg from the temple, hope the gods provide. Babylon had a better idea: create professional lenders, people whose job was moving money through time, for a price. First bankers were temple administrators. The temples owned massive amounts of land, collected tithes and offerings, stored grain, accumulated silver. They had surplus capital sitting idle, doing nothing. Some administrator looked at this and thought, why let it sit? When farmers need it, when merchants need it, when the temple could profit from it, so they started lending. Small amounts at first, to trusted farmers for one growing season, repay after harvest, with interest, 10%. 20%, sometimes more. The temple's silver now worked, generated returns, while still being available when needed. That's the birth of banking, idle capital finding productive use. Temples were slow, bureaucratic, religious. They had rules, restrictions, moral guidelines. The profit motive wasn't enough. Then private individuals saw the model and removed the restrictions. Merchant families started lending their own silver. They didn't care about temple rules, only about returns. They lent to anyone for anything, at whatever rate the market would bear. These were the first private bankers, the Ejibai family, the Murashu family, dynasties that operated for centuries. Their business, pure finance. No farming, no manufacturing, just moving money through time and space for profit. Here's how it worked. A farmer needed 60 shekels of silver for seed. The banker agreed to lend it. The contract was written on a clay tablet, specifying the amount, the interest rate, the due date, the collateral, usually the farmer's land or his future harvest, or sometimes his labor if he couldn't pay. The contract was witnessed, sealed, stored in the banker's archive. Thousands of these tablets survive. We can read the exact terms, see the interest rates, track the defaults. It's all there, in cuneiform, the first financial records in human history. The interest rates were high. 20% was standard, 30% common, sometimes 50% for risky borrowers. Why so high? Because risk was enormous. Crops failed, merchants got robbed, wars disrupted trade, drought killed harvests. There was no insurance, no limited liability, no bankruptcy protection. If the borrower couldn't pay, the banker lost everything. So they charged rates that compensated for risk, and it worked. Most loans were repaid. The bankers got wealthy. The borrowers got capital when needed. The system functioned. But Babylon went further. They invented deposit banking. Here's the innovation. Merchants traveling to distant cities couldn't carry tons of silver. Too heavy, too dangerous. Bandits, thieves. The road from Babylon to Damascus was lethal for anyone carrying wealth. So bankers created a solution. Deposit your silver in Babylon, get a clay tablet receipt, travel to Damascus, present the tablet to a partner banker, withdraw the equivalent silver there. The original silver never moved. Just the claim to it. This is deposit banking. This is transferable credit. This is the ancestor of checks and wire transfers. The tablets became tradable. If you owed someone money, you could give them your deposit tablet. They could redeem it. The debt was settled without touching actual silver. The tablets circulated as a form of money, backed by deposits at the banking house. This is fractional reserve banking, because the bankers realized something. Not everyone redeems at once. If you have 100 shekels in deposits, you only need to keep 20 on hand. You can lend out the other 80. As long as withdrawals are staggered, you're fine. and you're earning interest on 80% of deposits, while paying storage fees on 100%. The profit margin is massive. But what if everyone wants their silver at once? What if there's a panic? What if trust collapses? Then you have a bank run, and Babylon had them. The tablets record it. A banking house fails, depositors lose everything. Merchants who accepted their tablets, now holding worthless clay, the losses cascade. Other banks face suspicion, depositors withdraw, credit freezes. Sound familiar? It's the same cycle. Trust, leverage, panic, collapse. Banking crises aren't modern, they're ancient. Babylon dealt with them 4,000 years ago. The Code of Hammurabi tried to regulate this. Law 48. If a man has a debt and a storm destroys his crop, he doesn't have to pay interest that year. The principle is postponed. This is automatic debt relief, built into law. Law 117. If a man sells his wife or children to pay debt, they serve 3 years maximum, then freedom. This is bankruptcy protection, limiting debt bondage. The code understood something. Debt can destroy society if farmers lose their land. They become laborers. If laborers can't feed families, they revolt. So debt needed limits, forgiveness mechanisms, social safety valves. This is financial regulation, written into stone 3,700 years ago. But the bankers found workarounds. They structured loans to avoid the regulations, used partnerships to spread risk, created complex instruments that technically weren't loans but functioned like them. Financial engineering isn't new. The Murashu family lending records show sophisticated techniques. They made loans to farmers but structured as partnerships. The farmer wasn't a borrower, he was a partner, sharing profits, sharing risks. This avoided debt laws, but achieved the same economic result. Capital to the farmer, returns to the banker, legal innovation serving financial profit, tale as old as time. Babylon also had investment banking. Rich families pooled capital, funded large trade expeditions, merchant caravans to India, ships to Egypt, mining operations in Anatolia, projects too big for one investor, so they created partnerships. Each investor contributed silver, shared profits proportionally, shared losses the same way. This is equity investment. This is venture capital. The Ejibai family records show dozens of these partnerships, some wildly profitable, some total losses, but averaged out. The returns justified the risk, and the wealthy got wealthier by lending to productive enterprise. They even had something like insurance. Merchants shipping grain by river faced risk of shipwreck, pirates, storms, so they made agreements, pay a fee up front if the ship arrives, nothing more owed if it sinks, the fee covers the loss, the banker assumes the risk for a price. This is maritime insurance, born in Babylon, spreading throughout the ancient world. By Roman times, it's standard practice, but it started here, between the Tigris and Euphrates, someone calculating risk, charging accordingly, spreading the cost across many voyages, so one disaster doesn't destroy the merchant. Babylon even had futures contracts. A farmer agreed to sell next year's barley at a fixed price. Today, delivery in 12 months. The buyer paid a deposit, locked in the price. If barley prices rose, the buyer profited. If they fell, the farmer benefited. Both reduced uncertainty. Both could plan. This is a forward contract, a derivative. Its value derives from future barley, but it trades today. Speculators got involved. People who never intended to grow or consume barley, just betting on price movements, buying and selling contracts, making markets, providing liquidity. This is financial speculation. In ancient Mesopotamia, 4,000 years before Chicago futures exchanges. But here's what's important. All of this, every mechanism, every innovation, it emerged from real needs. Farmers needed seed capital, merchants needed credit for trade, travelers needed safe value transfer, investors needed return on idle capital. Banking solved real problems. It wasn't parasitic, it was productive. It matched capital with opportunity, smoothed consumption over time, distributed risk, enabled specialization. A farmer could farm because a banker handled finance. A merchant could trade because credit bridged the timing gap. Society got wealthier, more complex, more productive because finance worked. Until it didn't, because Babylon also shows us what happens when it fails, when leverage gets too high, when speculation overtakes production, when debt becomes unsustainable. The tablets record defaults spiking, families losing land, social unrest, the cycles of boom and bust, expansion and collapse, credit flows, everyone's rich on paper, then one bad harvest, one trade route closes, one war disrupts everything, credit freezes, the system seizes, wealth evaporates. Because it was never really there, it was future promises, discounted to present. When the future doesn't deliver, the present collapses. Hammurabi's law tried to prevent this. Debt jubilees, every 7 years, all debts forgiven, slaves freed, land returned, reset the system, start fresh. This prevented permanent debt bondage, stopped wealth concentration from destroying society, but it also made long-term lending impossible. Who lends for 10 years, if year 7 wipes it out? So the jubilees became irregular, then stopped. The economic incentives were too strong. Lenders wanted returns, borrowers needed capital. The system operated without resets, and inequality grew, and eventually, Babylon fell, not just to military conquest, but to internal collapse, a society crushed by its own debt. Fast forward to today, we have the same system. Loans, interest, collateral, deposit banking, fractional reserves, investment banking, insurance, derivatives, futures contracts, speculation, leverage, all of it. Invented in Babylon, refined over millennia, computerized, globalized, but fundamentally unchanged. We trust banks with deposits, they lend most of it. We use credit for everything. We speculate on future values. We structure complex instruments. We experience booms and busts, bank runs, credit freezes, financial crises. 2008 wasn't new. It was Babylon with CDOs instead of clay tablets. And we still haven't solved the core problems. How much leverage is too much? When does productive credit become destructive debt? How do we prevent crises without killing growth? When do we reset the system? Babylon struggled with this. Medieval Europe struggled with this. We're still struggling because banking is inherently unstable. It creates money from promises, turns future value into present spending, works beautifully until it doesn't. Then it collapses catastrophically, taking the real economy down with it. Babylon gave us the tools, banking, credit, investment. They unleashed enormous productive power, built cities, funded trade, enabled civilization, but they also created the cycle, boom and bust, wealth and ruin, trust and panic. We're still riding those cycles, still using those tools, still making the same mistakes. 4,000 years later, different technology, same human nature, same financial dynamics, same ancient system, born in Babylon, between two rivers. In a city that tried to reach heaven, and learned that credit can't replace solid ground. The first banking system, still running, still breaking, still shaping our world.